Hi, my name is Shrey Chande. I'm a financial analyst here with CART. I want to start up first off by thanking you so much for taking the time out of your day to view this video presentation for the information I'm going to be conveying to you. Truly helps me a lot to be able to communicate this over video and gain that, interactivity and interface ability that really isn't present in briefs or in one-pagers and memos or even in audio communication. So I want to thank you very much for that. Absolutely no harm done in not being able to schedule a meeting. I understand you're CFO of this gigantic company. To be honest, I don't know how you do it. Although I do admire you for your capability and success in leading this company. Overall, I just appreciate you being able to do this. But I guess let's just get into the nuts and bolts of this. I was called here today, I believe, to analyze a increase in the minimum wage for one of the states where we do have plenty of CART locations. This was a minimum wage increase from $8 to $15. And even though we already pay our employees $12 minimum wage in that state, that is a $3 increase per employee per hour in that state. Not necessarily the best thing for us financially, but you guys did hire me as a financial analyst for a reason. I'm here with a couple of solutions. So I guess let's just get cracking. So first off, I guess I'll just cover the most important and key takeaway of this. Our profit margin in the previous fiscal year was 1.99%. We had $419,000 and $419,750 in net income. And I'm just going to call that to be around 2% since we were $250 off. $420,000 would be 2% of profit margin. But the thing is that after this new $3 increase or $7 increase in minimum wage, technically only $3 for us since we do tend to pay our employees much better than their counterparts in other occupations and other retailers. We would be facing a net loss actually of $219,736 as projected with our increase in 14.5% for overall expenses. So we go from $419,750 of net income and we go down to $219,736 of net loss, taking us from 1.99% profit margins all the way down to losing 1.05% year over year. Not the ideal situation, most certainly not the ideal situation, but this is something that we can absolutely work around. First off, I guess I'd like to go over discussing an analysis of our company's financial situation using the financial statements that I was provided and also ones that I wasn't provided. I think the key thing that I want to go over first off is that our income statement looks good for the most part. The landscaping line item was a little bit weird. I'm very surprised that we spent $60,000 per store landscaping. It's moderately conservative, or it's moderately concerning, not moderately conservative, sorry. Moderately concerning to me that we spent so much on landscaping. That's definitely an expense we'd be able to cut back on in order to retain earnings without having to slice as many jobs. But along with that, I think some key ratios that I want to mention on our income statement was first off our gross profit margin, which is 23% last fiscal year, and it's going to be projected to be 23% this fiscal year as well, considering our cost of goods sold and our overall revenues won't decrease. We had $21 million in net sales, and our cost of goods sold was 23% lower than that. So overall, that is a pretty good profit margin. That's pre-expenses, obviously. If it was post-expenses, we would revert back to the 1.99 and minus 1.05 ratios that I mentioned earlier. Keep in mind, this 23% is the gross as opposed to the net profit margin, which used to be 1.99% in the last fiscal year and is down to negative 1.05% in this fiscal year. Along with this, we can analyze a lot of common size ratios just by looking at the line items. For example, landscaping makes up a certain part of our budget. Payroll makes up a certain part of our budget. Taxes make up a certain part. Cleaning, repairs, maintenance, etc. You get the gist of it. We can do a line item comparison, see exactly where we're spending most of our money, and that place is, for the most part, going to be in salaries and employee benefits for us. One other thing that I wanted to provide, though, is that balance sheets are much, much better with providing financial statements and to allow us to inspect the health of our company simply through, a list of numbers. So I guess the key ratios that the balance sheet provides us with are liquidity ratios, which essentially just allow us to see how quickly we can, pay down our expenses, or rather our ability as a company to be able to pay down our immediate expenses. Our operating ratios, which show how efficiently we're operating as a company, where we can do better, how we can do better, and all of that. And along with that, solvency ratios, which are similar to liquidity ratios, except for liquidity ratios are for expenses and solvency ratios are for our debts. Um, it's somewhat similar, but at the same time, two very different ratios. But the balance sheet overall provides the most essential info for determining our company's health if you're looking from a purely financial standpoint. Income statement provides us with a gross profit margin, as I said, of 23%, and the net profit margin of previous fiscal year 1.99%, and current fiscal year minus 1.05%, assuming that new minimum wage law kicks in and we do nothing about it. Moving on, though, I would like to address the nature of business ethics. Now, this is a touchy subject somewhat to go about, but I'll give you the gist of it, and it's just that ethics are kind of guideline for good behavior. It's kind of based on knowing the difference between right and wrong. I mean, that's the simplest way to put it. Behaving ethically means that we are being truthful, fair, and pretty much mindful of the law, really. In this case, we are being mindful of the $15 minimum wage law, and we are intending to comply with it. We are being ethical. We are intending on paying our employees, if we continue to retain employees in that state, $15 of minimum wage, and possibly more in the future. Overall, we are operating very well ethically as a business. I haven't seen any scandals in the news, about our $2.99 hot dogs only being 70% beef instead of 85. Don't see any issues with those for the time being, and I honestly don't see any of those issues being here for the long run either. In terms of marketing, we do have to keep our consumers informed and protected against fraud and deceit. We can't produce unsafe goods, which we already don't. Again, I mean, that's just the gist of ethics. Not too much to study about there. Next up, I want to talk about factors affecting our business's profit. There are obviously two key factors to any business's profit, and that's income and expenses. Simple as that. Delving more deeply into it, though, there are some other key factors, which are overall demand for the items we sell, which we are a consumer goods store. We sell a vast majority of the items that customers use on a day-to-day basis, so I'm not too concerned about demand affecting us. Prices, we're not really price makers, we're price takers, since we are in such a highly competitive market, grocery stores all across the board. We can't really set prices, we kind of have to go with the flow, and the overall health of the economy. Business is booming, I say we are too. Next up, I guess marginal analysis techniques and applications of this. So marginal analysis, in a nutshell, is essentially just analysis of how each unit of something presents a benefit or a deficit to something else. And I guess the best way to do this is essentially, I created a very rough mock-up of what our employee benefit chart looks like. And this essentially, marginal benefit chart looks like, sorry. This essentially shows for how many employees we have, how much benefit per hour they each produce. For the first 10 employees, these first 10 are the most important. Without them, the store wouldn't work. They are worth $70 per hour. The next 10 are worth 50, then 30, 25, 20, 15, and 10. As you can see, it tapers off very greatly, and this is because of the law of diminishing returns. The more employees we have, the less useful each employee is. So overall, we can see that once we hit that cap at 110 employees, they're worth $15 per hour, not necessarily any more than that, and nobody else is worth more than that either. Therefore, we can afford to pay 110 employees in each store $15 an hour and be pretty content with that. Moving on to the final thing, I guess, explaining the role of finance in business. This is a relatively simple thing as well, and finance is just the function of business that pertains to money management as a whole. Financial plans are obviously a very important part of any overall business plan, as profit is the bottom line. Elements that pertain to the role of finance in a business include, for us, example, equity financing or debt financing, growth financing, and a variety of financial statements can be used, like balance sheets and income sheets, like I mentioned earlier, to provide a way to analyze a company's overall financial standing. Overall, I guess that sums up the role of finance in business. But overall, for my final recommendations, I would have to say we can manage costs and we can retain our employees in stores in the state that has the minimum wage increase. Now, my reasoning for this and my justifications as to how we can do this, first off, we manage costs by cutting some employees. And my number for that is actually 6 per store. The reasoning for this is because we pay them according to my calculations, currently $15 per hour, or we will pay them $15 per hour for 40 hours a week for 50 weeks a year. That's assuming 2 weeks of paid leave total. And we pay them $10 in benefits, which I calculated using a ratio on the on the income statement, since it was a 3-to-1 ratio for income to benefits. So overall, we're paying each employee $40,000. Since we're at a net loss of $219,000 per store, 6 employees at $40,000 per employee will get us back in the green at $21,000 per store of profit. Not bad overall. Along with this, since we're only decreasing the number of employees by 6, and since each of our stores has around 120 employees, there would only be a 5% decrease in total employees, which would just result in a 5% increase in work for each employee, but that is also fairly compensated by the increase in minimum wage. Another solution is just to increase our sales of high margin products, for example, shampoo and dog food. But I guess those are my 2 key solutions. Please do email me back if you have any questions pertaining to this, but I thank you very much for your time.